Okay, thank you, everybody. We have a kind of a limited time slot today, so we'll go ahead and get started. Some people are still trickling in, but those of you coming in, definitely grab pizza. My name's Camden Hutchison. I am the director of the Center for Business Law here at the UBC Law School, and I'm very excited to welcome virtually Andrew Jennings, who's going to be speaking to us today. Andrew is an associate professor at the Emory University School of Law, where he teaches corporate law, securities regulation, and white-collar crime. His research interests focus on corporate governance and securities regulation. Andrew was previously an assistant professor at Brooklyn Law School, a lecturer in law and teaching fellow for the Corporate Governance and Practice program at Stanford Law School, and a scholar in residence at Duke Law School. He served as a law clerk to the Honorable Helen White of the U.S. Court of Appeals for the Sixth Circuit. He previously practiced law at Cravath, Swaine & Moore LLP, where he handled mergers and acquisitions and corporate governance matters, and at Sullivan & Cromwell LLP, where he practiced criminal defense and civil litigation. And Andrew is going to be speaking to us today about a recent article of his entitled Vice Capital: Investing in Sinful Companies, which I'm sure will be very interesting. So without further ado, I will let Andrew get started with his presentation. Thank you.
All right. Thank you, Professor Hutchison, for that introduction, and to everyone for joining the conversation today. It's good to be with you virtually from the East Coast. As Professor Hutchison mentioned, I'll be discussing a forthcoming paper that I and a co-author have coming out probably in a few months. Vice Capital, I co-authored it with Professor Kim Kravick at the University of Virginia. And there's a link there at the bottom if you're interested in getting a copy, just tinyurl.com/Vice Capital paper. This project is coming to fruition now in 2025, but it really had its genesis in the late summer of 2021 when we saw headlines like the ones that you see on the screen announcing that OnlyFans, a big platform at the time, and still a big platform, that had really come to prominence for hosting, in particular, adult content creators and raising funds for them or allowing them to sell content and serving as a middle intermediary for the adult content business. We saw headlines, though, that the company that was really known for adult content was sort of its raison d'etre, announcing that it was actually going to ban adult content, ban pornography on the website within a few months. Now, there are a few explanations for why this really abrupt shift in business model. The CEO of the company said that it was an issue with banking and financial services, that payment processors and banks weren't willing to really work with them to provide services to them, given the nature of their business. It was difficult to bank with their content creators, given the natures of their businesses as well. Other explanations included, well, perhaps OnlyFans is looking to go public, and maybe it would be difficult for them to find underwriters who are willing to help them go public, given the nature of their business. There's a taboo around adult content and pornography. Or perhaps OnlyFans has grown to be a pretty big company through adult content, but it has its eyes on other horizons. It wants to get even bigger. And to do that, it's going to need to raise some serious capital, perhaps from the venture capital community. And perhaps venture capital investors are going to be normatively constrained against investing in a company that is best known for adult content. And so perhaps there's the need to shift. Now, this got my acquaintance, colleague, and now co-author thinking. She is well known for her work in taboo trades and repugnant markets, which we might think of as commercial trade in products or services that themselves are normatively objectionable. We could imagine exploitation content, for example, as being normatively objectionable, tobacco perhaps normatively objectionable, or transactions in goods or services that perhaps ought not to be, or at least in the views of some, perhaps ought not to be commercialized. The very dealing financially in certain goods and services might be repugnant to some. For example, markets in human organs for transplant purposes, or markets for sexual services in the form of commercial sex work. And so I was interested in this story from the perspective of the capital markets and this idea that perhaps OnlyFans would have difficulty going public due to the normative aversion that many in the market might have to its business model, or that would have difficulty raising capital in the private markets due to normative aversion from its business model. So Professor Kravik and I began working on this question. We sort of settled on a title pretty quickly, Vice Capital, because of the callback to VC, to venture capital. And we decided to approach this project from the perspective of a qualitative set of interview-based studies. Now, we weren't the first people by any means to think about how vice or sin in terms of a business model or an industry that a company operates in might affect the market for its securities. There is a long literature that focuses on vice or sin stocks in the public capital markets, the publicly traded markets. And the idea there is that the value, the price that the market places on any given company's stock should more or less reflect a consensus of what the market believes the company's long-term free cash flows are going to look like, discounted to the present day. Now, there can be some disagreements on where that number should land. Obviously, the future can change, and it does change from day to day. That price, the kind of approximately correct price for the company's stock, might vary. But the basic idea is that we're going to value a company's stock based on its expected future performance. And through the arbitrage mechanism of a liquid and somewhat efficient market, we might imagine that if the stock price falls much below what the right price might be, or the range of a right price might be, then investors will bid up the price. They'll purchase those shares because they're getting the shares at a discount. They're getting a deal. The other side of the arbitrage mechanism is that if the shares of a company are trading too high, they're trading too high above the right price, so to speak, then holders will sell their shares because they're getting a deal. They have a premium product, and they're going to want to collect their premium. And so through that arbitrage mechanism, the price should be more or less reflective of what the market thinks the long-term cash flows of the company are going to look like. That might be different, however, for certain types of companies. And that's what this literature is really investigating. This is a literature primarily by finance and accounting scholars. And it asks, are there certain industries that are perhaps normatively objectionable for some investors? For example, I might object to investing in fossil fuel companies based on a moral or ethical commitment around environmental concerns or climate change. I might have a moral or religious objection to investing in a company that manufactures alcohol or that engages in the gambling business. And so perhaps I'm not willing to purchase those shares, even if there's a good deal to be had. And the idea that this literature is trying to investigate is whether there might be non-financial motivations that cause some investors to simply avoid purchasing shares in companies that they find normatively objectionable. And if so, does that lead to a potential premium? That is, people who are willing to go ahead and buy those vice or sin stocks get a premium because they have less competition in purchasing those shares. And there's a good bit of evidence in this literature that dynamic is occurring. The papers will use different definitions of what is vice or sin. That's something that we'll talk about toward the end of the talk today. There are perhaps disagreements about the size effects of this phenomenon, but there seems to be some evidence in the public markets that vice or sin might matter. It might impose higher capital costs on companies, or it might depress the value of their shares in light of the underlying business economics that they present. So, this is the public market. There's lots of data about trading of these firm shares. There's lots of data about the firms themselves. There's lots of data out there about their businesses because they have to disclose copious information to the public. We don't have that same vision into uh, an earlier stage of the market, which is what my co-author and I decided to focus on. We were interested in the startup companies that are beginning their lives, that are at the earliest stages of the capital market. Maybe they've moved beyond the stage of we're paying with our credit cards to finance the business, we're raising money from friends, family, and fools, but we're at that stage that we're first raising from some sophisticated angel investors and maybe early stages of raising from institutionalized venture capital firms. And so we're interested in this paper about how those venture capital firms are thinking about responding to or not responding to the prospect of investing in startups that happen to be operating in industries that might be considered vice industries. So that leads us to an obvious question, just what is vice? One takeaway from this paper, I hope, is that there isn't a given definition of vice. It changes with time. It's subjective. Different people have different views on what is vice or what is sin. But for the purposes of this paper, we do have to try to isolate a few kind of well-known candidates for what is vice. We call these the traditional vice industries in the paper. And so I'm happy to run through some of those to kind of level set. Now, just a warning, I am coming to this project from an American perspective, thinking about American capital markets and perhaps mores and industrial context. There will probably be some distinctions between this paper and maybe the experience of folks in the audience. I'm happy to perhaps tease out some of those comparative points in our Q&A session at the end, but I'll just present kind of the American lens here. The first category that we might think about would be adult businesses. We actually separate these two businesses into three categories. The first category might be commercial sex work, which is largely illegal in the United States, except for a few places. So we don't really analyze that side of the market as much because it's illegal and we're interested in legal or quasi-legal businesses. The other two categories that are largely legal in the United States would be images companies. These would be pornography companies, for example, or products companies, companies that are producing some physical product for the adult market. The other category, and I think there would be a lot of distinctions between the US and Canada here, would be cannabis, where we have this interesting quasi-legal system in the US in which a lot of states have legalized cannabis for either medical or recreational use. And the federal government continues to ban cannabis across the board. And so we've got this interesting quasi legal gray area to investigate when it comes to cannabis. We separate in our paper cannabis into two categories as well. The first is the non-plant touching category. These are firms that are not directly involved in the cultivation, the packaging, the transportation, the retail sale, the marketing of cannabis. And then we come to the non-plant touching companies. These are firms that are providing ancillary products and services to the cannabis industry. For example, specialized equipment manufacturers, specialized fertilizer manufacturers, specialized software companies that provide software services for the cannabis industry, et cetera. As we'll see going forward, there are some sensitivities that vary when we're talking about plant touching versus non-plant touching firms. The next category will include smoking or tobacco writ large. We might think about this as including cigarettes or other tobacco products, as well as vaping products. Next category of vice, classic vice, would be alcohol. Here again, we see some distinctions in how people perceive this particular vice with distinct perceptions around, let's say, spirits or liquor and wine, beer, or cider on another side. Gambling is interesting from a US perspective because for the longest time it was quite limited in geographic scope. Las Vegas and Jersey and Atlantic City and New Jersey were the prime places to go for gambling in person, and it was largely illegal in the rest of the country in most ways. Certainly, online gambling wasn't allowed, app-based gambling wasn't allowed, and so this was a highly regulated industry that was fairly geographically isolated. There's been a marked turn away from that prior status quo. Part of that is legal. There was a Supreme Court case in 2017 that cleared the way for states to liberalize their gambling laws, and we've seen them do that en masse. And so now, in much of the United States, you can engage in sports gambling through a regulated sports book, or you can engage in other forms of gambling online or with an app in your pocket. So this has been an interesting area of investigation for us because it does signal changing laws and perhaps even changing mores around one particular vice, and query whether that might change the way that venture capitalists perceive of that changing vice. Another category would include weapons. Here, again, we separate the weapons category into two buckets. One would include weapons for personal use, retail use of weapons, and the other would include weapons being manufactured for defense or police use. Fossil fuels, another area that has gotten attention as sort of perhaps a new vice, we might imagine. And so this is perhaps not part of the main traditional bucket, but it is an interesting area to investigate from a vice perspective. Now, how do we go about this project? We don't have data on the finances of vice startups. That data just isn't collected. It's not made public the way that the data for publicly traded firms is made public. We don't have trading data, obviously, either, because these are private companies that are not publicly traded. So what do we do to try to get some insights here? We conducted interviews with a lot of people to represent different perspectives for this overall question. We talked to founders and employees at startups in vice industries that have received venture capital funding. We've talked to venture capitalists who have made vice investments in vice companies. We've talked to VCs who haven't made vice investments, and maybe that's because they affirmatively won't, or perhaps they haven't confronted it yet. We've talked to angel investors who've made VC investments. We've also talked to the people who invest in the venture capital firms themselves. They don't get their money from nowhere. They get their money from limited partners, which represent oftentimes wealthy individuals or large institutions. And so as part of that, we've talked to faith-based limited partners, charitable limited partners that are not faith-based, higher education-based limited partners, so university endowments, for example, public pension fund, LPs, et cetera. And we also pull some descriptive data, as we can find it, from the PitchBook and the Crunchbase databases. So what did we find? I will give you some highlights here. The first finding is that vice is subjective, and it's unlikely to be fully captured in formal agreements. Let me illustrate for you here. If I am a venture capitalist, I am raising funds that limited partners are investing in. And those limited partners are going to have their own constituencies, and they're going to have their own normative concerns. Perhaps a religious endowment is going to think about its religious commitments, its doctrinal commitments within its faith when it invests its fund. Perhaps a university is thinking about other normative considerations and so on. And so if I'm a venture capitalist, I am raising money from all of those institutions for my VC fund, and I'm going to enter into a contract, a multilateral contract with all of those LPs, a limited partnership agreement, an LPA. I might also enter into side agreements, side letters with some of my LPs. If a religious LP has a particular objection to certain types of investments, I might enter into a side letter with that LP that says, we promise we won't make investments in the following industries. That has the effect of essentially locking up the capital of all of the LPs in that fund against investing in a particular industry because it's inefficient or even maybe not even possible to separate out the normatively objecting LPs funds from those of the non-objecting LPs. So every vice aversion that an LP brings to the table that gets embedded in a limited partnership agreement or in a side letter is essentially going to lock up the funds of all of the LPs. So these things can kind of layer onto each other, these objections. We might also imagine that we don't have to spell out in an LPA or in a side letter that the VC firm won't invest in certain industries that would embarrass or upset an LP. Why? Because part of my job as a venture capitalist is not only to raise the current fund, but also to keep raising more funds. I raise a fund and I spend it by investing in startups, and then I have to tend to that set of investments, but I also have to start thinking about my next set of investments. So I want to raise my next fund, and I do that by often going to my prior investors. The best way to keep raising money and hopefully raise bigger and bigger funds, if I'm a VC, is to go to my prior investors. And so in making decisions around investments in my current fund, I'm going to be mindful of the sensitivities of my current investors because I want them to be my next investors too. And so the restrictions that might occur in this LP-VC relationship may not actually be captured in a formal agreement. The next finding, which is related to the prior one, finding 1A, finding 1B, is that vice changes over time, yet it tends to be sticky. Well, what do we mean by this? Well, let's consider gambling, for example. Attitudes among VCs when it comes to gambling-based startups seems to be thawing a bit. Whether gambling is really considered a vice within that community anymore is a questionable prospect. We suspect that's partly due to just the expansion of the industry. It's becoming more ubiquitous. It's no longer isolated to two areas in the US. Particularly when it comes to Las Vegas gambling, there is always a whiff of organized crime that also perhaps scared away investors. Much of that stigma is gone now. And so query whether gambling or casinos or similar types of investments are so taboo anymore. Yet, given this dynamic in which we are entering into LPAs and side letters with our LPs, and we're repeating the relationship going forward, we might imagine that the LPAs and the side letters, the text of those doesn't change all that much. And in particular, we're probably not going to cut down on any industry exclusions. In other words, once you put an industry exclusion in these agreements, they tend to stick around. We found some examples in talking to folks about industry exclusions that were very much a product of their time and context that don't make a lot of sense anymore, but would be simply too awkward to try to take out to even bother to do so. And so even though definitions of vice might change, if I'm an incumbent VC firm, some of those restrictions might stick around for quite some time. Let's consider another category or another finding. The first is that vice might not see itself as vice. We found an interesting repeat phenomenon in talking particularly to founders who objected to the very idea that their businesses are considered to be vice. They acknowledge that outsiders would call their business a vice or a sin business, but many see their companies as providing some social good to the world. And isn't vice bad for the world? And how could it be that their firm is a vice firm when they're doing something good? Even those who acknowledge that perhaps they're offering a product or service that is not so great for the world, they noted that it does mitigate as compared to their competitors in the market. So maybe we are doing good by doing a little bit less bad. We might imagine that in the tobacco space, for example, someone might argue that smoking is bad. It's socially detrimental. It's detrimental to the person, but perhaps vaping mitigates that to some degree. And so there we see a rejection of the vice label by those engaged in vice businesses, or what would be considered to be vice businesses by outsiders. But interestingly enough, we didn't see a total rejection of the concept of vice aversion by these founders. That is to say, that they would identify other kinds of companies as being vice and therefore worthy of aversion, they simply reject the label for themselves. The third finding, which I've alluded to already, is that not all vices are equally stigmatized. Let's consider the cannabis industry in the United States, for example. Uh, there is a decent amount of venture capital funding for, or there has been in the past at least, for firms that are in the cannabis business, but they are providing non-plant touching services. They're providing software, they're providing labeling machines, specialized equipment, etc. They never actually touch the plant, however. There's far less interest, even among some cannabis specializing VCs, in any sort of plant touching business. The fear there being that direct contact with the plant could expose the investor, could expose one, the startup, to criminal prosecution or other sorts of enforcements, and could also expose the investor to that as well. We might also imagine that other industries have this same dynamic. For example, in the adult space, we were able to find founders and funders in the product space. We were able to learn a little bit about that. When it comes to images, however, we were not really able to find a lot of people who are willing to talk with us about running an images company, or particularly around funding an images company. So there might be different levels of stigma, even within a broad bucket of vice. Some additional findings for us to think about. Vice aversion isn't always normative, by which I mean some VCs will take an open view toward investing in a vice company or a firm that is vice adjacent. When I say vice adjacent, I'll define that in just a moment. But they recognize that there might be some real business infrastructure hurdles given the vice nature of a business. So for example, if I were to start a sexual wellness company, I provide a sexual wellness product. I might have a fine product, there might be market demand for it, a venture capitalist might acknowledge that, might not have any normative objection itself. Its investors might not have any normative objection either to financing the sexual wellness product. But let's say that the reason I'm raising funds, or I'm trying to raise funds, is because my biggest problem is marketing. I need to market the product so that customers out there know it exists. And perhaps I'm not really able to market the product in an efficient way. Perhaps every online channel that one would want to market on, Facebook, for example, Google, etc., has restrictive policies that won't allow me to market an adult product or a sexual wellness product. Certainly can't market it on television either. Newspapers are probably out and so forth. And so the venture capitalist might say, I recognize that this is a product that probably has a decent sized market behind it, or a potential market behind it, but you're simply not going to be able to get past the business infrastructure hurdles, even if you did get money from me. So I have to decline to move forward with you. Another finding might be that vice can distort startup governance and finance, and this is the area that I've been particularly interested in this paper. We can see in some instances that the vice nature of a business leads investors to demand overly controlling covenants to mitigate any risk associated with the vice nature of the business. We've also seen instances in which investors will take perhaps too much of a hands-off approach to corporate governance. For example, refusing to participate in board affairs or to directly engage in shareholder governance out of fear of reputational cost, or perhaps exposing themselves to some sort of liability given the vice nature of the firm's business. We've also identified that there tends to be a higher cost of capital. It's hard to quantify that given that there's a lack of data in this area as to just what the financing costs for these firms are. But anecdotally and in talking to experts in the area, we suspect that there's a pretty significant increase, premium cost of capital for these firms, separate and apart from their fundamental business metrics and risks associated with those metrics. We talked, for example, to one person who facilitates these types of financing transactions, who often will tell a vice company they're looking at about a 10% premium in terms of what the investors expect for their return, just simply based on there being a vice business. And then lastly, we observe that vice can hit differently for minoritized startup actors. And I'll talk about maybe three actors here. VCs themselves, the individual partners at VC firms, founders, and customers. We've identified some evidence that minoritized VC partners, women, people of color, are particularly sensitive around perhaps supporting or shepherding a vice capital firm to funding, partly because of a lack of institutional capital within their firms and a fear that a vice business might reflect poorly on them. And so there's minoritized VC partner effect there as well. We've seen it as well on the founders side. We've identified a lot of women founders in particular, and found that given the gender mismatch between who are VC partners, they're largely men, and female founders, that there could be a real problem there. So for example, among women who are founding a sexual wellness startup that is focused on women's needs, there might be a total rejection of the idea, whereas a startup founded by men focused on men's sexual wellness needs or health needs might still struggle given its association with sexuality, but ultimately succeed in finding capital. We've also identified some effect where some products or services might be identified as vice adjacent, products that are simply health related, but nevertheless deal with sexuality. They don't deal with sexual pleasure, but merely sexual health, as being labeled too close to vice to give comfort to some VCs. And then we also see some effects on the customer side. So for example, if a startup is building a product or service aimed at women, it might be identified as a niche product by some VCs, even though it's more than half of the population. The perspective of male VCs is that something that is aimed toward women might be niche. And then we've also identified some of that same effect happening with products or services that are geared toward the LGBTQ community. Some implications for this paper. First, we think that we complicate what vice means. We make things harder, frankly, for our friends in the finance and accounting worlds if they continue researching vice in capital markets, because as we show, the definition of vice is highly subjective and it changes over time, which does complicate matters in terms of doing an empirical quantitative study in this space. We identify what we think are some new buy-side mechanism implications for why there might be a vice premium, why investors in a vice company might get a premium. And then we also consider real economy effects. For example, if products or services for men's sexual health or wellness are struggling to get funding, but ultimately do get funding, whereas products for women's sexual wellness or health just aren't getting funding, what effect might that have downstream in the real economy in terms of the products and services that are available for individual consumers? And then some extensions that we're thinking about going forward. We're interested in what happens when a startup grows up and joins the public markets. We have some examples of that. And we're also interested in what I call maybe the hidden vice within the public markets. For example, maybe a company that operates a chain of liquor stores or that manufactures alcohol will experience a vice discount in its pricing in the public markets. Maybe a lot of investors simply don't want to invest in a company that makes its profits from selling or manufacturing alcohol. Yet we might imagine that a large retail company, big box stores like Walmart or Target in the United States, sell enormous volumes of alcohol, whereas they are not really thought of as vice companies. Another example might be Disney, very wholesome company. No one would ever associate Disney with vice, except Disney does have a large stake in an online sports book. And so if you are buying stock in Disney, you are getting some exposure to the gambling industry. And so these are some potential extensions or things to think about for us going forward. And with that, I'm really looking forward to questions or comments from the group here. And once again, if you'd like to get a copy of the paper, it's available at tinyurl.com/vice capital paper.
Okay, thank you so much. So we've got about 10 or 15 minutes for questions, and I will exercise my prerogative as moderator to ask the first question. So the first question I have is, you talked about how venture capital investors are able to demand a premium from Vice companies, and I was just wondering, did you encounter any evidence in your interviews of, I guess, like vice seeking on the part of venture capital investors, right? So given that a lot of vice companies are going to have to pay, they're going to have to pay a greater return to their investors. They're going to have a higher cost of capital. I was just wondering, is there any venture capital investors who seek those firms out specifically for that discount and that higher return? And I have no idea, but I'm sort of thinking, like, in particular, like, I think a lot of venture capital investors and limited partners, they're not, at least in certain circumstances, they're not public facing the way that, big institutional investors in public companies are. So they might be less worried about the political or reputational repercussions of those types of investments. So basically, have you seen any evidence of people, kind of seeking out these sort of sinful or vice companies in order to get a higher return?
Yes, there actually are a decent number of VC firms that I call vice specialists. We particularly see them in the alcohol space, the cannabis space, or psychedelic space as well. These are firms that are going to specialize in investing in vice startups. But it's interesting that you should ask that because they suffer some of the same effects as the Vice startups themselves face. So they have some of the same funding hurdles because they have to go out and find LPs that are willing to write a check to them, given that they are specializing in Vice. And so where we see a lot more room to operate is among wealthy individuals and family offices who may not have a particular vice aversion that, say, a university endowment or a religious charity or a pension fund might have. And so there we have one source of fairly unconstrained funding. But for these vice specializing VC firms, they run into some of the same problems. They tend to be smaller, so they can offer less scale. There's often somewhat of a funding gap as well, in that I might be able to raise money from a vice specialist for a Series A round, for example, but they only have so much capacity. They tend to be fairly small themselves. And so if I want to get to the next level and raise a B round or a C round, raise more serious capital to grow, well, there's a real kind of hole there in the market because the vice specialist at that point can't really write those checks. And the bigger firms that could write those checks are likely to be vice averse and they won't write a check to me.
Thank you. So I guess I'll moderate any other questions in the room since I'm in the room here. Who has questions? So yeah, Maziar, go ahead.
Hi, Andrew. Thank you so much for the very interesting paper. I had two quick questions for you. One was, I know that this is an empirical project, but I was wondering if you have a normative take on it too, on these findings. I was reading your paper on corporate criminals, and you make some really interesting normative points about, the problem with the M&A space in that particular area. So I was wondering if you have any similar observations here. And the other thing I was going to ask you is that you mentioned that, the dynamics could change when, a vice firm goes public. So you talked about Disney and then how they try to keep it hidden. Have you come across any examples that actually a vice firm goes public and they sort of proudly own that? I mean, or no, it's always, they try to hide it and they use the structures that investors don't actually know that they're dealing with the vice firm here. Thank you.
Great questions. I would say that we probably avoid a normative takeaway for this paper. We're really trying to capture the phenomenon and theorize what's happening. I do have a solo paper that kind of jumped off from this paper called Criminal Investors, which looks at that question of when is the investor potentially exposed if there's an illegal business. We see this in the cannabis space, for example, where there is this non-enforcement at the federal level in the US, but it remains federally illegal. And so is an investor in a business like that potentially exposed to criminal liability, whether on some conspiracy or accomplice sort of theory? So that paper, I think, does have more normative content, but I think we've largely avoided doing a normative approach with this. I can't speak for my co-author, but we're not suggesting that firms should invest in Vice or that they are doing something wrong by having these aversions or that these aversions to Vice are inappropriate. I don't think we take that view one way or the other. So we're really just trying to describe and theorize this phenomenon in this paper. And then the second question, could you remind me of that real quick, please?
Yes, it was about when the companies go public. Have you seen any interesting examples of that? Not like the Disney model, but where you see a vice firm going public and actually the investors, know very clearly that they're dealing with the vice firm.
Yes, so there's an interesting story there. There's an online app called Grindr, which is an LGBT dating app that has some history to it that was very Vice concerning to a lot of investment banks or investors back in maybe 10 years ago or so. It wasn't something that investors or investment banks would really touch. It has now gone public and has become somewhat more of a normal company in the view of the markets or market participants. So that might be one example of a company that had a Vice tinge to it. There is at least one publicly traded adult cabaret company in the United States, which has a strategy of acquiring individual clubs and growing its empire that way. So that's maybe one example of a company that has gone public. It's been around for a while, I think, that is squarely in a Vice space. Now, you can imagine, I haven't looked at the recent IPOs, but there might be some vaping company or something like that that has gone public as well, gambling as well. So I think there are some examples of that, and we have some information that didn't make it into this paper around how investment banks deal with Vice businesses that might be fodder for a future paper.
Hi, I was just going to ask, you talked about some new trends and how certain like gambling is shifting from being a vice to just depending on kind of the legal frameworks around them. Do you have any predictions as to what you think the next shift in, vice enterprises will be in, I guess, your jurisdiction or just more, I guess, North American?
That's interesting. I think, we have an interesting environment now in which I think regulation around adult businesses is increasing in the United States. Regulation around gambling is decreasing. Probably regulation around alcohol is decreasing as well in the US. Although, from what I can tell, millennials and Gen Z are killing the alcohol industry because they're not drinking, according to a lot of the people in that space. So that's an interesting dynamic as well. In terms of what the hot new vice might be from a market or regulatory perspective over the next few years, that's an interesting question. I'm not sure I have a prediction on that front. I'll take that back, actually. One frontier area that I've heard from a few of our interviewees might be in the psychedelics space. So if we've seen liberalization around cannabis in the US, I think we might start to see perhaps liberalization around psychedelics, particularly if they're used for medicinal purposes. So that might be an area to keep an eye on over the next 5, 10 years or so.
I actually have another question, so I'll go ahead. So my question, this is sort of, when you're talking about vice industries, and this question, I'm really sort of thinking about kind of the polarized political environment in the United States. But, as you pointed out, and as is obvious, like vice is subjective, right? So different people are going to have different understandings of what is vice. And, I think some industries like adult entertainment, probably some people have no problem. A lot of people have no problem with it, but I think many people would recognize that it's at least been traditionally understood as a vice. I think many people would recognize that it has problems, that there's a lot of risk of exploitation and that kind of thing. So, there's some vice categories that I think are sort of, labeling them as vice is non-controversial, right? So I'm thinking probably like adult entertainment is the best example. And maybe, like drugs, alcohol, maybe less so, as those are getting sort of more accepted. But I'm thinking about sort of industries that are, like truly divisive industries. So like you had the example of firearms. I think that's kind of the best example, right? So there's a lot of people in the United States who would consider the firearms industry to be a vice industry, to be a dangerous industry, to be an industry to be regulated, and to be an industry that is morally objectionable and should be avoided from an investment perspective. While there's many Americans, perhaps just as many Americans, who not only consider firearms acceptable, but consider them like a really important aspect of American political life, and are staunchly politically opposed to anyone who's trying to regulate firearms, or anyone who claims that firearms are morally objectionable. You can maybe make similar arguments about fossil fuel, as that's become increasingly politicized, right? So now it's not just regulating fossil fuel. You have a lot of people who are pushing back, and they're like, no, actually, if you're trying to regulate fossil fuels, that's woke, that's, we need more fossil fuels, right? So these things are becoming really divisive. And I guess my question is, like, did you, in your interviews, and like, I think firearms is probably the best example, but I'm sure that there's others, where it's sort of industries that are not necessarily vice, but are very divisive. And does that make investors, more or perhaps even less willing to invest in those industries? If my question makes any sense.
It does, and I think it's really going to depend on who their constituents are. If they have a set of blue state and red state public pension funds as their investors, they're probably going to try to steer away from investments that make either side potentially uncomfortable, because no one wants their LP, the person who's running the state pension fund, or the contact at the state pension fund, to suddenly have to deal with an inquiry or pressure from a state legislature, which is upset. And so I think the answer to your question is going to be just subjective as to who the underlying LPs are and what their preferences might be.
Yeah, I think so. So, sorry to interrupt you, but I think that's a great answer. And just to frame my question better, not that your answer kind of like allowed me to reframe my question. So, like, I guess, are you seeing any politicization or any political division within the venture capital industry, right? So, are you seeing venture capital firms or venture capital investors that have a sort of political tinge to them, such that they would be, willing or unwilling to invest in different industries?
This is a great question too, and I think the answer is going to be a bit of an artifact of when we did these interviews. So we asked questions. We saw at the time of the interviews in largely the summer of 2022, so several years ago, emerging sort of state level pushback on aversion to certain companies. For example, in Florida and Texas, we saw this. And then in some blue states, we saw it with respect to firearms. And so we did ask particularly people who maybe represent those state pension fund perspectives about this dynamic. And I think there's a little bit in the paper about that. We didn't get a clear story at that stage in 2022. We didn't really talk to the VCs about any politically salient considerations really at all, which I think is an artifact of the time. I don't think that we had this sense of kind of strong lines in the sand down Sand Hill Road that we might have after the last US presidential election. So I think if we went back and did these interviews again, I suspect if we were to ask questions along that line, we might pick something up. But just in the time that we did these interviews, we didn't really delve into that with the VCs themselves.
Thank you. Any other questions in the room or online? Sounds like no, so maybe that is a good place to end our talk. So let's give a round of applause to Andrew.
All right, thank you all.
Thank you so much. So thank you, Andrew, and thank you everyone for coming. And yeah, look forward to future events from the Center for Business Law. Thanks.